Sometimes Philadelphians are faced with tough decisions. Where to get your cheesesteak is not one for me. However, with or without, very important decisions. In mortgage banking, do you want it with PMI or without PMI? Let's go inside and we'll talk a little. On second thought, I think I'm going to enjoy this and we'll just have to talk later.
So, Peter, is there any doubt in your mind that Dalessandro's is the best cheesesteak in Philadelphia?
The very best cheesesteak. It was very best cheesesteak in 1970 when I went there, I think, for the first time.
And you went to Penn Charter, so you were right down the road, right?
We used to cut school and go to Dalessandro's, and it was the place to hang out, man. Still the best.
That's not a bad place to grab lunch.
No, not at all.
So, you were talking about with or without, in terms of whether you're getting fried onions on your cheesesteak or not, but that also kind of implies the mortgages. Why don't you explain a little bit what you mean by that?
So I'm a big wit fan when it comes to cheesesteaks, but I'm not a big wit fan when it comes to PMI. So PMI, which stands for Private Mortgage Insurance. Private mortgage insurance can be attacked in several different ways. I don't think it's a bad idea because I think it allows a lender to lend you now up to 97% of the purchase price. So without private mortgage insurance, you couldn't do that. So it's a good thing. But if we can avoid the payment, it's probably even a better thing. And one of the reasons I like to make the payment go away, the new tax laws take away your ability to deduct the private mortgage insurance on your tax.
So just to clear this up for the general public, you can have PMI when you do a conventional loan, and if you're putting down less than 20%, you're going to have private mortgage insurance in your monthly payment. But we're fans of not having it in your payment, correct?
Right. There are several things you can do. Again, if you're putting down 20% or more, you don't have private mortgage insurance because the lender is allowed to lend you 80 cents on the dollar and not really care. It's when you're putting down less than 20% that the lender he needs somebody to insure his interest. Private mortgage insurance is not insuring the borrower, it's insuring the lender.
So the borrower is paying for insurance, and it's not insuring them, it's actually insuring the bank that you don't default.
Correct. So the bank is only responsible for 80 cents on the dollar, and the private mortgage company is responsible for everything thereafter. So it's a very cool thing that it lets you do this. When they took away the ability to deduct it, the private mortgage insurance companies got very smart and said, all right, if it's going to take me 13 to 14 years to get my money back in monthly installments, I'll give you a pretty steep discount if you give me the money in advance. That steep discount, by the way, is I think it calculated out to 59.9% of what it would be over that 14-year period.
So instead of paying it out as monthly payments, they said that if you just pay us this lump sum up front, we'll give you this huge discount and it will give you a lot of savings in the end.
Tremendous discount, and it was a lot of savings in the end. And then they gave you two different ways to deal with it. The most popular one is the one that everybody hears about called LPMI, which stands for Lender Paid Mortgage Insurance. So what the lender does is the lender says, hey, Mr. Borrower, I'll help you out here. I'm going to pay it for you. And the way I'm going to pay it for you is I'm going to raise your interest rate a bit so that I make enough money to be able to pay it. It's called an extra premium. So the lender says, I'll pay it. It'll never be in your monthly payment. And I'll just raise your interest rate to cover it. No foul. And your savings, by the way, compared to the guy with private mortgage insurance is pretty substantial.
So the mortgage company is taking care of that upfront premium of insurance, and in order to kind of get even, they're going to raise your interest rate as a result.
Yes. And the way I like is what we call the Advantage Program. The reason we call it the Advantage Program is because I want to take advantage of the fact that I can now deduct more in my payment than I could otherwise. And so what the Advantage Program is, it says, hey, Mr. Borrower, here's this lump sum money. Instead of raising your interest rate, which, by the way, your PMI was around for about 13 to 14 years, I'm going to raise your rate for the next 30? That sounds crazy to me. So we came up with the idea that how about if you got to borrow that money? How about if they charged it to you in a fee, but they let you borrow it, and therefore you could finance it out over those 30 years? The interest that you're paying on it's deductible, and you're taking advantage of every possible positive gain. You're taking advantage of the discount. You're taking advantage of the deductibility. It's a great loan. Your payment is less. Your interest rate is less.
And because you're financing that into your own loan, the lender's not paying it for you, and your interest rate stays the same.
Yes. The negative side, if there is a negative side, is that your loan amount is a little higher because we just borrowed it, kind of like an FHA loan does. So they let you borrow that money. I get some people who say to me, but my loan amount's greater. Well, if you stay there for 30 years, they both pay off at the end of 30 years, so do you really care? If you stay there less than 30 years, I'll tell you, if you stay there 15, it's still an advantage. If you stay there 10 years, 8 years, I'll tell you to make the payment on the LPMI against the Advantage loan, and you'll have greater equity in your home than if you did the LPMI loan alone.
So what we're trying to say here, I know this gets a little bit complicated, but your monthly payment on our Advantage One program is going to be less than an LPMI loan. And so if you take that amount of savings and apply it directly towards principal each month using the Advantage One loan program, you will pay down that loan faster. So it really is a better deal. It's just a little bit more involved.
We're just playing with money, and we're just making it work to your advantage. I mean, that's where the name came from.
So, Peter, I've been with you for a couple of years now, and I've seen you do this with a bunch of different loans, and it seems like whenever somebody wants to put down less than 20%, but they don't want PMI in their payment, this Advantage One program really kicks the crap out of the LPMI option.
It absolutely is a cheaper payment, no matter how you slice it. The discount's a little bit bigger. You get a lot of cool perks. And again, I think having the same interest rate as a regular loan, not having to raise the rate to cover the cost, I think is truly, you're taking advantage of several different pieces.
So what's the major pro and con? We know that if you have a ton of money saved away and you're going to put down 20% and you're going to have assets and reserves, that is going to be the best option because you're going to get rid of PMI completely.
All depends. So everybody has a different theory. And you and I have had the conversation several times. So loans shouldn't be what I want them to be. They should be what the customer wants them to be. We just want them to make an educated decision. If I polled 10 different financial planners that I do business with, I would venture a guess that 9 of them would come back and say put down as little money as possible, because with interest rates still as low as they are, take advantage of keeping the cash because these rates are pretty low. And for those of you that think, the new rate, because they've gone up a little bit, the new rates are higher than, you want them to be, keep in mind my first interest rate on my first house was 14.25%.
That's incredible.
Again, I believe cash is king, and so I like to see you put down as little money as possible and take advantage of some of the perks that are out there.
Cool. Well, I think it's a great program, and I think it's worth, if you are in the market to buy a home, if you are going less than 20% down, especially if you're going conventional, you really need to look into our Advantage One program because it can end up with a huge savings.
On a monthly basis, it is definitely better, and if you apply certain things to it, it'll in the end save you even more money. It's a big plus if you qualify. The key is, like every other loan, the higher your credit score, the better deduction, or I should say the better reduction of costs in your private mortgage insurance as well.
Definitely. Well, Peter, thank you for shedding a little bit of light on the decision to go WIT or WIT out,
thank you for
PMI.
Thank you for the cheesesteak.
Doing a little bit of a Philly spin on things, but we look forward to talking with you guys again soon, and that's a wrap for today.
Thank you very much, and enjoy both your cheesesteak and your mortgage.
Have a good one.